Hello YouTube, this is the Average Investor here. This is my next video on Warren Buffett and the equity bond. Um, the information for this video came from another Mary Buffett's book called The Warren Buffett Stock Portfolio. And in this book, Miss Buffett basically described how Warren Buffett goes about choosing the various companies that he's invested in over time. But his general way of going about selecting these companies she discusses fairly in depth for the first couple of chapters, and that's what this video will concentrate on. So in general, Warren Buffett likes his companies that are usually very old and very old companies make predictable products which make predictable profits. He looks at companies that spend little on research and development, and companies that are old usually have predictability of earning stream. So a predictable earning stream usually means consistent earnings. Consistency in earnings is very important to Warren Buffett. He usually looks at a company's 10-year earning history to determine if this is a company that he would like to invest in or not. Companies that don't show consistency are usually not good term investments, and these are companies he usually avoids. So erratic earnings is something that he looks for. So erratic earnings is a company that produces a commodity type product. Usually a product this company produces is usually competes solely on price, such as airlines, such as Southwest, American, what have you, and not on the uniqueness or brand recognition such as Coca-Cola. So Warren Buffett essentially discovered that a durable competitive company could be actually thought of as an equity bond. So companies that have durable competitive advantages usually have earnings so predictable that they actually behave like bonds, which is why it's called a equity bond. The rate of return on the equity bond is actually the company's net profits or earnings per share in a given set of years. So if a company's net profits, or i.e. earnings per share, are increasing, say, 10% per year, that would mean that this company's equity bond rate of return is actually increasing over years. So usually, if you buy a bond, you usually have a fixed rate of return that does not increase. But an equity bond, which is a durable competitive company, actually has an increasing rate of return. So an example of this would be, say a company has a share price of $150, and after earnings per share are approximately $8. So you could think of the rate of return as $8. And if the annual increase in earnings is, say, 10%, you could theoretically calculate that in 10 years, such a equity bond, its rate of return actually could balloon all the way to $20.75, $8. And over the years, the market would actually react by recognizing this increasing in the equity bond rate of return, which would actually then result in an increase in stock price over time. So one example of projecting a future rate of return could be if we use Coca-Cola. So Coca-Cola usually has a consistent rising earning trend. And if you looked at the last 10 years, you could see that Coca-Cola's earnings per share has been increasing. So there is a website that I will include on at the bottom of this video where you can calculate this rate of return. So in 2001, the earnings per share of Coca-Cola were approximately $1.60. Then in 2011, the earnings per share increased to approximately $3.85. The annual rate of growth was calculated to about 9.18%. So if you calculate 10 years further, so say 2021, the earnings per share go from $3.85 to $9.27. So here is the first here's an example of the first website where you put in the previous present value. Here was the 2001 value of $1.60. The future value was actually the 2011 value of $3.85 earnings per share, and the years were of course 10, and calculated annual compounding rate of growth rate was 9.18%. And this website, if you gave the present value of $3.85 and you put in the rate of return of 9.18%, and in 10 years you could calculate a future value of $9.27 in 2021. So if you want to calculate what would the possible future stock price would be in, say, 2021, you would look for the company's PE ratio, or most conservative PE ratio, in the past. So in the past, the lowest PE ratio for Coca-Cola was approximately 16. And if you multiply the earnings per share of the future of in 2021 of $9.27 and multiply by 16, you come out with a possible future stock price of $148.32. If you also include the stock split that happened in August of 2012, that same stock price in 2021 would actually be $74.16. That's compared to today's value of approximately $35. So there is two big provisos, though. You have to watch out for that you have to look for a constant annual rate, and also the lowest PE ratios. If the annual rate is not constant, this value would actually be worthless. Also, if you put in a P ratio that's extremely high, you get an extremely high future stock price, which would be totally wrong. So Warren Buffett also looks at per share book values history to identify companies with a consumer monopoly or its intrinsic value. So if you also want to look at the intrinsic value of a company, Warren Buffett looks at the book value per share. And long-term growth in book value can be used as a rough estimate of long-term growth in intrinsic value. So here's an example from my charts. The blue chart is that of Coca-Cola. You can see its book value has been increasing approximately 200% over the last 10 years. And Sony's book value has only increased by approximately 35% in the past 10 years. So this is the end of the equity bond, and I hope to see you later. Or I hope to speak to you later. Bye-bye.